Index funds. They're often considered by investors and traders like you and I to be some of the safest places, but they're starting to see large withdrawals. And with the Dow Jones and the Russell 2000 both falling as the Nasdaq and S&P 500 make new highs, what's going on underneath the hood? Well, one thing's for sure, we're starting to get a concentrated market. And as history shows, that really tends to end one way. But more importantly, there are other markets that we might start to need to think and pay attention to. And in today's video, we'll break it all down together. Join us as we cover stocks, commodities, and cryptos for the week ahead. Well, welcome back everybody to The Daily Show. My name's Tom, and we've got some massive macro and data in today's video to go through because, of course, we're seeing mass leadership again thanks to semiconductors and some of the biggest tech stocks in the world. The biggest worrying sign right now has to be financials. So let's get into it together. And if it's your first time here, remember to subscribe and smash that bell icon if you love markets like we do. So let's kick things off in today's video because we've got some amazing valuation stuff coming up as well, and get into this chart here from Grant Hawkridge. And basically what it tells you is that high cash flow businesses with growth behind them are doing very nicely. S&P 500 versus the Russell 2000, we continue to see that increase. The S&P 500 versus the World Country Index, when we exclude the US, that's also been increasing. And in monetary policy statements, the way that we see them right now, modern monetary theory, this is kind of what we've been having for the last 10 years. In fact, if this turns around, you need to start to question where you're at in terms of the overall bull market. Most notably, we saw this happen with the Russell 1000 growth versus value switch-ups that happened in 2021 and, of course, led into the significant fall in 2022. So why does this chart become important? Well, it all comes back down to what's going on in the markets right now. And as we know, this great periodic table here from Jury and Timmer basically goes through some of the best returns this year. To put it back into perspective, Bitcoin is number one this year. Gold is number two. And of course, you could argue some AI stocks are in there as well. But the S&P 500 is certainly not performing poorly. And it's had two now pretty good years behind it. And that tends to continue to lead on. But we'll go through why everyone's so concerned right now. And of course, Goldman Sachs Breadth Index here from Mike Siccardi is showing us that it is a very narrow breadth market. Current readings are 14 on the breadth read, and multiples are starting to get disconnected a little bit in some of the hottest markets. Specifically, you'll notice the infotech market starting to really jump up there to 30.4. Now, in a special soon, we'll take a look at whether this is still attainable and good. And of course, we'll be breaking down NVDA in particular because you might be surprised that NVIDIA is still trading at the literal forward PE average. This is the forward PE average of the last 5 years. Now, when you see that in a future video, you'll be like, oh, okay, it was actually cheap recently in terms of its 5-year averages because it did live up to expectations so far. But as you can see here, there are some very crazy concepts in terms of where these big banks think this market is going. And they're starting to make some pretty big calls. As we knew, they would do some updates, and they're starting to come through. So recession risk, they believe 4,800. Some type of really nasty market, 4,700. And their baseline is now becoming 5,600 at a 20x in the future. And of course, an exceptional mega cap run is as high as, yes, you heard it, 6,300. Now, this is what basically the big banks are starting to price into their charts. And you can see why stretch positioning is actually not going up. Now, one of the reasons why that's happening is because we are stretched in very particular stocks, but not across the board. So you'll notice here, Goldman Sachs stretch position indicator actually went down, and the general consumer, this is the most recent report of the general kind of investor out there, is completely confused. Bears 32%, neutrality 29%, and bull 39%. So this is kind of more on the averages, as you can see here by historical averages. Almost a balanced market between people that want to absolutely sell, people that want to buy, and people that have absolutely no idea what's going on next. So why is this become important? Well, it really comes just down to every single earnings season. As we know, this market is being run by just a handful of stocks. And this is pure concentration. What happened during the dot-com bubble and actually what happened during the 1960s. Other periods of time that we've seen such things as this were, of course, also what happened, which was more of an everything bubble, including housing, which was the Japanese bubble of the 80s into the early 90s. So why is this also quite important? It's because look at the S&P 500. The S&P 495 stocks are actually getting revised down, while Microsoft, NVIDIA, Amazon, and Google are being revised up to a point where they have to continue to hit. And there's a good chance they might, because we are seeing such interest in the AI space and, of course, such huge demand on NVIDIA chips. If we look at the relative performance versus the S&P 500, and this is a great chart to do. To ever put this on your chart, by the way, all you need to do is you need to put whatever particular index, let's say it was XLF, financials, of course, I watch quite closely, and then we look at that versus the SPY like this, and you'll see this type of chart appear. Now, what you might notice is that their recommended positioning is pretty wild. They basically are positioning infotech, utilities, consumer staples, healthcare, and energy. Now, does that sound like they're positioning towards growth? Well, it doesn't really sound like it yet. They're basically saying, yes, we're going to be in the concentrated market, infotech, then we're going to buy defensive, and arguably kind of like a political play at the moment, which is the energy side. Also a pseudo to the AI revolution in terms of that and utilities both also helping it. So Goldman Sachs' new recommendation is go big on growth and go defensive on everything else. And if that doesn't sound like late cycle starting to be in position, I don't know what does. And almost every chart here is starting to really get hit around. Now you'll notice consumer discretionary recently has been holding up better. And the likes of Shop and a few other stocks that we've been discussing have actually been starting to turn around to the upside. But everything's down across the board except for, of course, information tech. And that's really brought through here with this all-star charts that shows the financials. And of course, it's highlighted because financials are the most important in this kind of run. They're now trading well below or below their 20-day moving average. And it will be important to watch those this week because we want to see financials just kind of tick up. They don't need to go ballistic, but they do need to continue to hold some of their major supports or demand zones. If things like KRE start to fall through, that can create a shock in markets. And as we know, this is not really the thing you want to be seeing in a healthy market. You do want the financials to be coming along to show that the backbone, which is the debt system, continues to do okay. If we have a look at large caps versus mid caps versus small caps, it becomes plainly clear that everyone's just been in large caps over the recent couple of weeks. And you'll notice that by one-day moves, percentage months at 1 day high, at 1 month highs. And of course, when you look at things like the mid caps, things are starting to get weaker as you go through the field. And that's being really represented by, of course, the US 2000. Industry groups, this is kind of a play here on things like transportation, energy, healthcare. All of these sectors are actually down versus the S&P 500. And they will eventually turn up, especially if we're going to continue to run. But that could be after we see the growth movement. And of course, you can see here from Bank of America, they believe that the current valuation ceiling represents buying opportunity. So it's now become a big thing here that they say, well, I don't really care too much about the CPI either way. What we're looking for here is PE valuations that, yes, they're getting stretched, but we think they can stretch further. And this is the type of thing that starts to break through into bubble territory. Basically, we don't care about the valuation too much. We'll just buy it and we'll just keep rallying that thing because that's how we're going to make money. And it's leading into calls such as this from Goldman Sachs. As we mentioned before, 6,300 is their new mega cap exceptionalism run. So they believe 6,300 is possible. A catch-up period is possible of 5,900, and their baseline has now become 5,600. So this is a huge step up from where they were only a few months ago, and they're continuing to basically call in this idea that into 2025 will be quite bullish. Forward multiples continue to trade at fairly wide margins. Of course, equal weight still really relatively cheap at 16, 21 on the overall market. And it's still not quite up there with some of the previous bubbling periods, such as 2021. And of course, the forward PEs of the historic dot-com bubble. So everyone's drawing this catalyst to here. And that's fair enough as well in many ways, because it looks like we're leading into those types of concepts. Now, what about the Fed? The Fed came out this week. They said, we're possibly going to look at a cut. Obviously, we'll look at data dependency. But when you look at their dot plot, it's clear no one has any idea what's going on, and they're completely clueless. They're basically hoping that they can sort this out. And again, the market is kind of on top of that, going for the concentration play. And we know that that does tend to be the rule book during these times. And we also know, and I always put this out there as a warning, that this never, ever ends well. In fact, every time we've ever seen these types of things occur, they always end very, very poorly. What about market leadership? Well, the gap's getting wider than it has for a very long period of time. Be great to get this chart actually back into the 1990s, so you could see how wide it was back then. But basically 2,100 S&P 500 points are now made up of the top 10. And we're starting to see NVDA calls where people are saying 15% of the entire market is going to be NVIDIA, that one stock. So they're obviously believing it's going to become not only the biggest stock in the world, but a lot bigger than that point. And that brings us into secular bull market theory. So basically, we are following this trend at this stage. A fairly bullish market, obviously looking for signs of price action and warnings out there, especially from investment perspective. And we're around this point here, which basically tells us that if we're going to run similar types of distances than we've seen before, then we could be looking at around an average of 60 months. Now we're in about 21 months here, according to the new bull run. So overall, the cycle, we've obviously gone quite far. But if it's going to extend to just the average of a new bull market, which started in 2022, then it could go upwards of 60. I tend to believe it'll be less than this, and it'll be somewhere in that 40 range or even 30 to 40 range, which means that we kind of start to firmly put ourselves in 2025, 2026. So what do you think in the comments down below? Does it make sense that we're going to continue to see these things rally? And do you think that it's going to become a hyper bubble like it has before? So of course, at all-time highs, it isn't unusual to see funds start to sell down. Profit taking, especially over the last couple of weeks, is to be expected in index funds. But what we started to see last Thursday was strange, and it reminds me a little bit of what we had back in previous sell-off periods. We're starting to get those 3x funds showing some large dark pool transactions. And this one came in at the close and led into, of course, a gap down in the market, which was filled right back to the same level. Now, this will become important when we take a look at our analysis in just a few moments. But as you can see here, this is a level where clearly someone made a fairly large position and possibly looked towards that weakness side, taking profit on the positive end. What about the rotation on Friday? Was that defensive? Well, it was the same kind of concoction, I guess you would say, in terms of what we've seen recently. Gold came through with the goods, which was pretty interesting. Dollar, obviously, big moves on that. We'll talk about that soon. XLK, XLC, two of the most popular, semiconductors, and then strange amounts of defensive positions. Utilities, healthcare, staples. Obviously, anything that wasn't really cash flow positive, even though we've seen things like solar do better over the last 5 days, that was sold off throughout the Friday session, really kind of amplifying those US 2K losses. If we look at ITB, this is, of course, home construction. That was down, but as we always should do, let's have a look at it over the 5 days. And it's been metals that have been copying it, and I think they're coming into a very nice zone right now. KRE, which is back on support, down heavily, and of course, all the normal leaders at the moment coming through. The solar, the biotechs doing okay, and then we've got defensives, consumer discretionary coming out of nowhere, and of course, semiconductors at the top. So let's jump into the charts and have a look at what's in store for us for the week ahead. So we'll do a top down here, and as we know, the S&P 500 closed almost near its highs, and that was pretty strong. It sold off during the morning, and it rallied through the day, and we can see that on the smaller time frames. Breadth still remains a huge issue in terms of if you believe that breadth will kill it, but as we know, concentration can continue up the markets, and we continue to have a gap, and remember this level, 53.75. So that's where we've got a gap in the markets due to that CPI figure on last week. So if markets come back down, let's say they actually start to sell off, in here, we're probably going to see some form of buy support. And I think this will be a very interesting level for traders to be watching. In general, the market went down and actually just filled pretty much the gap by the end of the day. So there wasn't that much interest on the Friday session. What started to become pretty clear, though, is that markets are still wanting to go towards that positive gamma situation. And basically, options continue to be piled in right around strikes. You'll actually notice that the Monday strike is underneath the close price. So call resistance is underneath the close price. Again, if the market stays high throughout the session, it will probably have to continue to push, and that could push us into eventually 5,500 and even beyond those levels as we see all these big banks up their targets and then say to their clients, oh, yes, you know, we're ready, we think this thing is going absolutely bullish. This is, again, the typical type of thing that can happen in these points. Now, when we jump down here, you'll notice that this is where we get into the interesting levels. Now, I've got the most traded level here. I've got an anchored VWAP sitting behind, and I think that this also would make sense from some Fibonacci pullbacks. So effectively, this will be a very interesting zone between the put support, remember that's also a gap fill level, of 53.75 and 53.55. This is really where the market will find the sweet spot if it does drop to maybe see buying pressure. And of course, at the moment, that is the current market. That is basically what's been happening. The main answer why? Well, it's a chart like this. Positive gamma situation, constant large strikes. This week, of course, being OPEX, which for anyone that doesn't know is the largest options expiration of each month, and huge amounts of strikes between 5,400 and 5,500. If the market does manage to stay up throughout the week above these levels, I mean, it seems clear that the magnet is going to be 5,500. If they want to make as much money as possible, it is possible that the market will try to sit below the 5,400. So this week will be good to watch on, I think, the smallest time frames, those 15-minute, 1 hours, and of course, daily closes. S&P 500 CTAs getting back to the top. So basically, they've still been neutral to up. Same with the NASDAQ ones. We saw Brent starting to sell a little bit here, but again, nothing big from the CTAs recently. And gold almost making a new low from the CTAs, which of course is a worry when you think about it as a chart that continues to make lower lows and lower highs. Now, am I bullish on gold still? Yes. But of course, that is a larger time frame. That's not just a few days and weeks. That's talking about it over a 6-month, 12-month, and 18-month period. Let's go through some of the other popular stocks. Tesla disappointed again by not managing to close above the magical 182.50 and couldn't get back into the positive gamma. So we're back to neutral now. 175 is where the buying pressure is. Spot's 178. And as we know, 180, 182.50 is where the buyers really would come back into that stock. NVDA continues to be really positively geared. Basically, you can see here, everyone's buying calls across the board, and that's putting a lot of pressure on the stock to be hedged off. And I think on Friday, dealers were like super behind. Like it was like $12 billion or $10 billion or something. It was some extreme amount of options they were out. So that led to the market stabilizing and obviously spot price increasing a bit. Still the hottest stock in the market, still the most amount of options flowing through it in terms of just general speculation. What about the charts? Well, let's get into the lead indicators here together for the week ahead. First up, little bit worrying here to see the bonds indicator versus options start spiking again. So that's starting to spike up there. Again, early days, no price action on S&P. So just something we look at. It hasn't broken out or anything like that. US 2-year kind of closed at 4.7, which I would say closed right on the boundaries. Of course, the market, if you were usually shorting this, which I don't actually trade yields much, but if the yields were actually, if you were looking at this as a normal chart, you might actually start to scale in on a short here because it closed underneath the wick. But yeah, with yields, I'd say it's still stuck between the 4.7 and 5. You can see here that home construction managed to hold itself right at the base. Again, didn't go negative. DJT, which is Dow Jones Transportation Average, another lead indicator, that closed pretty negatively. But a lot of people are saying, well, this is a dead read because basically the new DJT is semiconductors. And if you put semiconductors on a chart, what's it look like? It's a vertical to the moon at this point. So I think that would be fair to also put through that growth versus defensive sector of the Russell 2000 into that discussion. S&P 500 still has central bankers basically supporting the market. You can see here a little bit of central bank liquidity injection across both the world and the Fed. And you'll notice over here, we still continue to be in that possibility, guys, because we do have a red stop sign here showing that this is a little exhausted. We got our other one here. And I'll never discount these red stop signs because, as you know, these can indicate temporary weakness. That if we manage to gap down, so if this market freaks out for some reason, that would be an island reversal. And that can expose at least down into this level, if not back into these 5,200 zones. So I think the thing here is to be cautious, but still follow the trend. And caution just basically means if the price action is looking way more negative and has a lot more reads on it that are going negative, you might want to say, well, I'm going to wait for a turnaround on that price action back up if you're a trader. For an investor, you're probably not going to be as worried about it. Let's move over to the US dollar, and US dollar was really strong. So even in the face of yields going down, the US dollar took a massive rise and it came back to trade at the most traded level, kind of saying and signifying, you know what? maybe we're going to go to a new high in the dollar. Now, this is not something I expected. I didn't mind doing this, and obviously I was not going against it other than that one day in here for day trade. But those positions are gone. Like, they got wiped. And basically at this point, you've got to say, well, this was a real wick. This was the buy pressure zone, which was pretty much a 61.8 fib. And this thing has traded now to the most traded level. So basically it's coming back up pretty strong. And if it manages to close above 105.50 this week, I could see this thing really flying up. So the dollar has reversed what was looking quite negative from it in just 2 weeks. And this is off the back of course, everyone claiming that inflation has been narrowing and going away. So it's an interesting one there when you look at the dollar. What about copper? Sitting at 4.5, so right on kind of the middling zone. No news for copper yet. And then we move over to gold. Now, I thought I'd start off with the weekly here. So, of course, we had a bad weekly looking candle last week. It didn't make a new low, which is often a good trigger for a day trader. So that didn't happen. And we managed to find some buyers throughout the Friday, basically coming back to some interesting zones. The big point here, the most traded level. And we've seen this a few times. Now, for aggressive buyers, they would have been looking at literally this level. We spoke about a 61.8 pullback being a possible zone, but I'm still not convinced that gold has necessarily turned around. We don't have the CTAs, and we know that it's still making a series of lower highs and lower lows on the higher timeframes. So unfortunately, not much structure just yet, but for some people, that'll be an encouraging sign. For me, the way I look at it, this was certainly a very encouraging level to see hold, because you can see that's the zone, and I would like to see new highs. And of course, I'm happy for swing traders to take it above 23.80. And if that starts to occur, then yeah, hopefully we're in another run for gold. For now though, there is still weakness in the charts. So on the higher time frames, you could see a new low. And remember, that will expose, if it closes below this 22.70 point, I think it'll expose 21.75 or something around there. Silver is practicing the same kind of thing. It's in the middle of nowhere land for silver, and it's just consolidating throughout. So we'll update that if we see interest. What about oil? Well, it's doing something that doesn't actually look that negative, and that is consolidation at the most traded zone. So this is the most traded zone, and we've got 1, 2, 3, and 4 days of consolidation. Now, if that breaks to the upside and closes, it's more than likely going to take out 80.50 and move quickly towards 84 a barrel. If it sells off, the buyers sit somewhere around 75.50 a barrel. So there's two interesting zones here this week. And as you break down the structure, you'll see what I mean. Basically, the market is grinding higher, but it's still consolidating. And this can be considered accumulation, especially if the market breaks up. So usually what I'd be looking for is something like this. And Bitcoin actually might be showing something like that. We'll go through that very, very soon. All right, let's move over to Tesla. Long leg doji fest continues. 1, 2, 3, 4. 4 weeks, no close high. Very disappointing for the Tesla bulls. This thing just cannot hold up, yeah? But at least it's still above most people's probably buys throughout this level. So we'll see whether it does get through 182.50 this week, and we'll be watching that. NVDA, nothing much to report. We just continue to struggle, move higher basically with a series of higher closes as we're in massive positive gamma. And you know what they say, don't fight the trend. KRE, interesting. So this is the banks. And as you can see here, if we put a line through, very important point for the banks this week. I'm going to set an alert above 48.50 just in case it happens, but you'll be wanting to see KRE not continue to weaken. And that will, I think, be important for the whole market to continue up. We want to see KRE and XLF start to find bid. And the good news was that we did see a little bit of bid after falling off on Friday on the XLF trade. So XLF, hopefully it does start to improve. Speaking of improvement, of course, Chinese stocks coming under a lot of pressure recently. But 700 Tencent, I liken this to one of the leaders of that market, continues to look pretty good on the chart. So we bought that up quite a few times, and it's up a little bit at this stage. And as you can see here, HSI still looking weak. So to get this into the strength aisle, we'll need it above 18,200 for initial, and I could see it going to a 61.8 fib still. So, very interesting zone. Watch Tencent, I think, the most closely. For it to break out probably is going to lead into strength of the Chinese market. Oz 200, for the Australians out there, nothing to report. Flatlining through the most traded zone and the high. So basically just waiting for new information, I think, for inflation figures, because of course that could drive things like copper, gold, and a lot of things that Australia is well known for. US 30. Now, this is where the weakness starts. So, of course, the US 30 has had this supply, which has been a good short, and it continues to make a consistent level of lower lows and lower highs. As long as that holds up, of course, the market is looking quite weak from these perspectives, and it's just getting more and more concentrated. And it is a worry. Of course, you don't want to really see these types of things, but this market continued to act actually technically. And if you look at the US 2K, it was a really bad closure. Now, it actually closed right on the tweezer low, took the low, didn't find that much bid. But yeah, that first bull level over here didn't find any bid through the start of the session. It just kept falling and falling and falling, and it's led on to this point. Now, the Russell 2000 is a bit of a conundrum because some of the stocks are obviously doing well. Case in point, if we have a look at this chart here, which is, we'll just grab it here. Here it is. IWF versus VONV, which basically is growth versus value on the Russell 1000. You can see that actually the growth stocks of the Russell have been doing amazingly. The problem is, and this is the problem sometimes with index investing, is the Russell 2000, 20+% of it is like KRE, regional banks. And of course, regional banks, well, they're not faring so well. So when you've got a huge index that's so stacked with businesses that don't make money, as we say a lot, 37% of the businesses don't make money, and some of them are a bit toxic, like some of the ones in here, then it's not going to do as well. So probably the better read to be constantly having on your charts will be something like this one here, which is the growth versus value. And we've put it on the charts before, and you can see here it's actually been doing very well for quite some time, and specifically incredibly well throughout 2024 with some very strong bid prices from April really leading into that massive growth. And that's thanks to, again, AI stocks. NASDAQ 100 still driving higher, still getting closer to that, kind of warning sign, stop sign stuff. Again, it's just a point to be cautious, I think, here as these markets drive higher. Watch the small time frame price action. And then we move over to the crypto world. So the crypto world shows Bitcoin here finding a base and hit into that bottom end of the box. You can see it actually hit my box bottom and found a little bit of a bounce. No turn here for Bitcoin yet, but at least there was some encouraging wick action. A lot of people are saying when Bitcoin, well, maybe this week's the week because it's kind of got to start going soon and it really needs to not fail here. Some notable levels for the week ahead would be above 67.5. Probably need even above that, maybe like 67.8. And that would start what I believe is a short-term time frame change coming off the red box, which we suspected may get hit, especially when it failed to get above here. Now, of course, above 70,500, that'd be fantastic for Bitcoin buyers, but we'll see whether that can happen. News around the world for the week ahead, guys. There's a lot of news, but then not that much for the US. Core retail sales, CPI for a few countries, RBA statement, press conferences from many central banks. And of course, we go through and you can see here that we've got flash services PMI at 9:45 New York time. So it's a week of many other central banks having a chat about what's going on. And that means that, of course, I'm sure it will be moving markets. Remember to subscribe and smash that bell icon if you enjoyed what you watched today, guys. Have a great weekend. And of course, follow along if you're interested